Looking at discount revenues, that's where the business gets a discount from a creditor to settle its account. So it could be that a supplier gives us an invoice for $200 for something bought on credit. We pay $195 to settle the account and get given a discount of $5 for the difference, which we call discount revenue. But why exactly is it a revenue? So to answer that, we're going to go back to the definition. So a revenue must be an inflow of economic benefits or a savings and outflows. It must increase assets or decrease liabilities, and it must ultimately increase owners' equity. So taking a standard revenue, which is a $200 cash sale, let's assume there's no GST in this case, that would make our cash at bank asset go up, which would be a debit, and our revenue called sales would go up on the credit side. Going back to our definition, why is this revenue? That's because there's been an inflow of economic benefits in the form of cash. There's been an increase in assets, in this case the cash at bank asset, and ultimately owners' equity has gone up. But looking at a situation where we've been given a $5 discount off an account of $200 from a creditor, we need to figure out what would have happened if we didn't get the discount. So if we didn't get the discount, the outflows of economic benefits to settle this would have been $200. We would have had outflows in the form of cash of $200. But if we do get a discount, in this case $5, the outflows of economic benefits are only going to be $195. So overall, because of the discount, the firm's going to pay less cash, which is less economic benefits, and therefore there's going to be a savings in outflows of economic benefits. So it's going to be the other part of the definition. So looking at this very basic example, we'd have creditors go down 200, so that'll be a debit. We've got a revenue, revenues go up on the credit side, in this case of 5. And we've also got less cash. So in this case, a cash asset is going to decrease, which will be a credit of 195. So we've got one debit to match with two credits. Why is this revenue? It's a little bit different to a cash sale. It's not an inflow of economic benefits. The business is actually instead having a savings and outflows of economic benefits. What's the saving? The firm's paying less cash to its creditors. There's going to be a decrease in liabilities, not an increase in assets like with the previous example. What's happened with this one is the liability has gone down, in this case the creditor's liability, and overall there's been an increase in owner's equity. So looking at the two examples side by side, cash sales was a revenue because there was an inflow in the form of cash. It made an asset increase called the cash asset, and owner's equity went up. Discount revenue, that was different. Instead of there being an inflow, there was a savings and outflows. In this case, the firm saved cash. Instead of an asset going up for our second characteristic, a liability went down, in this case the creditor's liability, but overall it did make owner's equity go up, which is something that both share in common. Looking at how we'd enter this into a journal, we'd take our cash paid, add in the discount we received, and that equals the total owed to the creditor. So in this case, we paid $195, we got given a discount of $5, that's total of $200 owed to the creditor. So what we're going to do is add in a new column to the cash payments journal in between bank and creditors, and that's called discount revenue, and they're in green. So looking at this basic example, we'd enter the details. The bank column would have $195 in it. There'd be $5 of discount revenue, and creditors would go down $200. So you can see the creditors column is the total of the bank and the discount column. Looking at an example where we've paid a creditor $200, no discount, bank goes $200, there's discount revenue of none, and creditors of $200. Looking at another example where we pay $180 and get given a discount of $20, bank is $180, discount revenue is $20, but creditors is still going to be $200. We're still going to lower the amount we owe to a creditor by $200. We've just been given a discount and had to pay less cash in this example. A third example could be we pay $150 and get given a $50 discount. So we've got $150 in the bank, discount of $50, and the creditors column will be $200. So in all three examples, creditors has gone down $200. We've just done it with a different mix of paying and getting discounts. We still need to post our columns, so we know how to post the bank column. That's going to be a credit to the cash at bank ledger. It's going to make cash go down. But we're going to have to post the total discount revenue. That's going to be a credit because revenues go up on the credit side. Looking at the creditors ledger, creditors are going to go down in this instance $1,850. That's made up of some discount and some cash. So looking at our references, we can see in creditors we've got one reference to discount revenue and one reference to cash. And in the credits, we've got in the cash ledger and discount. Where will we find the matching debit? We'll find it in the creditors ledger. A more efficient way to do it in the creditors ledger is actually just to do one entry. So that way we don't have to break it into the $90 discount and the $17.60 of cash. We can just do one giant total of $18.50 and do the reference as cash/discount revenue. The bank column now, we've got a slightly different formula. What we're going to do is do the bank column must equal creditors column less discount revenue plus all the other special columns plus sundries plus GST. So looking at some individual transactions, on the 8th of April, we've got the bank column of 1,000. Looks like we've paid a creditor. That's $250 discount was received, and creditors have gone down $12.50. So bank is equal to creditors less discount. The insurance, the bank there is equal to the sundries plus the GST column. And the stock there, we've bought stock, so the $16.50 in bank is equal to stock plus the GST column. We can now check, it's a checking mechanism with the totals, and make sure we've entered everything correctly. So the total in bank 5290 should be discount revenue subtracted from creditors, which is $12.50 less $2.50, plus all the other special columns, plus the sundries, plus GST. So that's called a checking mechanism. Summary of posting for the cash payments journal, which ones are debits and which ones are credits. The bank column was a credit, discount revenue was a credit, creditors was a debit, stock control was a debit, wages was an expense, so that was a debit. Sundries will be debits because they're either going to be wages or assets that we've bought, or perhaps drawings, which is a negative owner's equity. And lastly, GST will be a debit because that's when we pay GST, which lowers our liability.